make this relatively short, hopefully interesting. What, about a dozen-ish people? About that.
Good roundtable discussion.
Yeah. So, first of all, it is being filmed. Normally I would say Chatham House rules, but it doesn't work when it's going on film. So I guess we'll just encourage everybody to express their opinions. I'd like to try to not get into too many rabbit holes, which is easy for a bunch of experts to do. So we're going to start by having a thought experiment, and we'll go around the table very quickly. And I used to do this a lot in my graduate seminars. So it's now 2040, 25 years from now, roughly.
Good night.
We're still alive.
Barely.
Everyone's healthy and healthy, happy, and doing well.
Still alive.
And we're reflecting back on the amazing, unpredictable growth of equity crowdfunding alternative finance in the United States. And so the term alternative finance, of course, went away with the demise of banks in the 2030s. But so my question then becomes, what drivers were there that were triggered by the Jobs Act that actually had transformative effects on the U.S. economy?
Part of what I would expect to see 25 years from now is that small would be big again, in that you have technology that's essentially creating the opportunity for small players to compete on a big scale. You don't have to be, you think about cloud computing, you don't now have to have $100 million in order to set up a pretty sophisticated organization. And so with crowdfunding, as it grows more and more successful, there will be more opportunities for people to raise modest amounts of capital, to capitalize businesses that are stable and grow, but don't become gargantuan. And so I think we're entering an era today where big is actually dangerous and small is actually going to be much more powerful. And I think 25 years from now, you'll see that play out with a much more dynamic mix of businesses, be more creative destruction as small companies come and go, but there'll be a lot more dynamism in the economy in general, and certainly in the capital markets specifically.
I think that what's going on now will create a lot less friction in the capital markets, I think it makes it easier and quicker to raise capital, which can sometimes be dangerous. But I do think that lack of friction is going to really change the intermediary space.
That anyway, even well-intentioned people who are completely honest sometimes fail, and there was a time in this country where failure wasn't a crime. Now it's probably more like a crime.
Okay, I can make transactions with anybody, but the minute you start getting involved with public investors, whether they're accredited or unaccredited, there's different risks.
The Title III rules are going to be perfect for this, and this isn't 20 years from now. This is immediately. A cottage industry of service providers is going to pop up, who, for example, manage debt. So you make a debt instrument. A dry cleaner needs all new equipment, needs $250,000. You can't just give the guy $250,000 and expect, whoever put the money up, to him to properly handle that. So it's going to have to go to some intermediary who then's going to spread the payments out. So a number of new industries need to develop around. But one thing for sure is that we have a lot of legacy systems in the United States. A lot of people have jobs. Listen, we could obliterate income taxes, but then a million CPAs wouldn't have jobs. So somebody wins, somebody loses, and the government doesn't like to make those choices. The capital markets make those choices, but the government doesn't like to. And so,
But that's a good.
You can get much more. You can get your money much more easily on the crowdfunding the donation platforms where you're pre-selling the product. And the audience will tell you whether or not you've got a product.
I think that crowdfunding will also have a role in I don't think it's going to be one or the other. I don't think that crowdfunding will replace venture capital entirely. I think that they will still have their role. I think that as you look at Regulation CF, I think that will really take the place of friends and family. Maybe not take the place, but help facilitate a friends and family round. That's that spot that's going to fill. But then you have 506C offerings and Regulation A offerings that can help push the venture capitalists farther down the road, or maybe replace it entirely. But I think there'll still be those deals. There's a lot of venture money out there that's chasing deals.
the development of data and resources and research and whatnot will come up. You can envision down the road research firms coming up and doing spot reports on different industry segments, possibly even companies themselves, because both the cost and the distribution of that research may reduce in price to where you have the crowds themselves, the benefactors of third-party research, just like the public equities market, or even the private equity or venture space. There's a handful, probably dozens of firms that do private market research that you can access and are engaged by the PE firms before they make a decision. The venture firms the same way. So taking research and reducing it in size and cost to support the crowd, I think, is a natural proposition.
Activity to broker dealers and being able to trade is what opens up the markets. And then some of these companies, you look at NASDAQ in the 90s, and yesterday we were talking about what they were. They were capital formation for small entrepreneurial companies, right? We're kind of in that phase right now. And we have different types of companies that can come to market.
It goes to that we now have a pretty good spectrum of capital raising choices. You can do a Reg D, you can do a Reg D 506C and advertise it. You can do a Reg A, you can do an S1. You can pick where you're yet in that
That's
spectrum.
why I'm going to pay for it.
Absolutely, and it's why I like what the OTC is doing so much, because they're really making it clear that it's not public or nothing. There's a spectrum of choices. You can have a little bit of liquidity with an issuer buyback window like Steve is doing. You can have a little more liquidity if you want to allow transactions between existing shareholders, through the transfer agent or at the clearing broker. You can have a little more liquidity and visibility if you want to be a QB or maybe a QX company.
Yeah.
If you're big enough and you're mature enough, you go all the way up to one of the national exchanges. But you have a choice, and you pick the choice that makes sense for your size and your revenue.
The vitality of the entrepreneurial community will grow, and you'll have more activity, more innovation, more capital formation, and enough companies will be profitable that the sort of the combined wealth will grow. So yeah, I think absolutely it will be a positive thing.
Yeah, the pie will grow. Well, I think we need to wrap for today. I appreciate everyone's time. And Sydney, do you want to make a closing comment?
No, I just want to thank everybody that have been here in the last 2 days, and Dr. Swart and everybody, and our sponsors again, and we appreciate it. Your students and everybody, we're going to have this next year in Silicon Valley. We're here. Thank you.
Thanks, Sydney.
Thank you.